Have you ever wondered how a single decision made in a quiet boardroom can end up affecting, well, everything? Today, we're going to unpack that. We're going to look at just one day, December 11th, 2025, to see how these hidden threads connect the entire global economy. Let's get into it. So that's the big question, isn't it? How does one little event create this massive domino effect? To figure it out, we're just going to follow the money. And that trail starts with the most powerful financial institution on the planet. You know, every story has a starting point, a single moment that gets the ball rolling. For the story we're telling today, that moment comes from the very heart of the global financial system, the U.S. Federal Reserve. Okay, so picture this. You're a trader on Wall Street. Your eyes are glued to the screen, and then bam, this headline hits. The Fed is cutting its key interest rate. Now, that isn't just a piece of news. It's a starting gun that kicks off a frenzy of activity all over the world. The new number is 3.75%. That's a 25 basis point cut, which is just a fancy way of saying a quarter of a percentage point. Now, you might be thinking, that sounds tiny. But the real news was the message that came with it. The Fed basically promised that no more rate hikes were on the table. And for investors, that's a huge sigh of relief. So what's the Fed's game plan here? Well, it's a classic 1-2 punch. First, they're signaling they're less hawkish, meaning they're not looking to raise rates, which calms everyone's nerves. Second, they're injecting a cool $40 billion into the system by buying up government bonds. You can think of it as literally greasing the wheels of the economy, just making it cheaper for everybody to borrow money. All right, so the Fed has made its move. Now we get to watch the reaction. In the world of finance, news moves at the speed of light, and the very first ripple from this decision hits the U.S. markets almost instantly. Think about it like this. If your bank suddenly cut the interest rate on your savings account, you'd probably start looking for a better place to park your cash, right? That is exactly what happens on a global scale. With lower interest rates, the U.S. dollar suddenly isn't as attractive, so its value drops, and at the same time the return you get on government bonds, it falls too. And you can see the proof right here in the numbers. The U.S. dollar index, which is basically a report card for how the dollar is doing, it plummets to an 8-week low. This isn't just a number on a screen. This is the market saying, message received loud and clear. Honestly, this didn't shock anyone who was paying attention. As one market analyst put it, this is a mechanical flow. It's like a reflex. The Fed cuts rates, the dollar falls. It's a predictable chain reaction, and it's only the first one we're going to see today. But this story doesn't just stop at the U.S. border. The dollar is the world's currency, so they say when it sneezes, the whole world catches a cold. So let's follow this ripple across the Pacific to Japan, where the Fed's decision is about to make a huge splash. And there it is. As the dollar gets weaker, the Japanese yen gets stronger. It's like a seesaw. But this isn't some abstract financial concept. This has real-world consequences. A stronger yen makes Japanese exports from companies like Toyota and Sony more expensive. So a decision made in a room in Washington is now directly hitting jobs and profits over in Tokyo. Okay, so we've seen how the Fed's move sends ripples through the currency markets. But the global economy is this incredibly complex beast, right? There's always more than one thing going on. So let's shift gears and look at the world of commodities, where two totally different stories are playing out, completely separate from what the Fed is doing. On this very same day, we have a tale of two commodities. In one corner, you've got crude oil, which is basically drowning in a sea of oversupply. And in the other corner, you have silver, which is shining bright because demand is just off the charts. These two markets could not be on more different paths. Oil is in a major slump, hanging out near a 7-week low. And the problem is simple: supply and demand. All the major producers are pumping out so much oil that the world is literally swimming in it. And when you've got too much of something, the price always falls. Now let's flip over to silver. While oil's in the basement, silver is soaring, hitting a new all-time high. So what on earth is causing this massive split? Well, the answer is a powerful trend that's been building up for years. This is what economists call a structural deficit. Basically, for 5 years straight, the world has been using more silver than all the mines combined can produce. You think about it, solar panels, electronics, demand is just booming, but the supply coming out of the ground is flat. It's a perfect storm, and it's what's sending the price of silver through the roof. Okay, so we've got the short-term shock from the Fed and these long-term trends in commodities. But there's a third, even deeper force we need to talk about:
the strategic chess moves of the world's biggest companies. And on this day, we are seeing a huge wave of deal-making that's going to reshape the economy for a long time. And the numbers, they're just staggering. We're on pace for nearly $4.8 trillion in corporate mergers and acquisitions this year. This isn't just about companies trying to get bigger, it's about them making huge, bold bets. It's partly a sign of confidence, but it's also about survival in a world that is changing incredibly fast.
So, what's driving this feeding frenzy? It's really a mix of things. First, you've got the return of the mega deal. We're talking those huge, multi-billion-dollar buyouts. Then, of course, there's the AI gold rush, with tech companies snapping up smaller firms to get a competitive edge. And finally, you have these scope deals, where companies are basically buying their way into completely new markets. It's a sign of a very dynamic and, frankly, restless economy.
So there you have it. You've got a Fed decision rippling through currencies, two commodities on totally opposite tracks, and this massive wave of corporate deal-making, all happening on the same day. It might seem like total chaos, but if we connect the dots, a pretty clear picture starts to form.
So, what did we learn today? First, central banks are like the conductors of the orchestra. Their decisions can change the music in an instant. Second, the real world of supply and demand still matters a lot. It creates these powerful trends that move on their own. And third, the long-term strategies of big companies, they're like the tectonic plates of the economy, shifting slowly but changing the entire landscape.
This one day shows us that the global economy is this complex dance between short-term shocks, long-term trends, and strategic bets. And it leaves us with the ultimate question, doesn't it? In a world where everything is this connected, where do you think the next big surprise is going to come from? Because, as we've seen today, the answer could be absolutely anywhere.